In this week's update, no question about a major change of character for US markets. And what stocks are likely to fall less and rebound first? My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is general information only. Last week, I covered the concept of markets being in transition. We don't know yet to what, but let's look at some of the fundamentals. The US rapidly and increasingly is at risk of quite a dramatic economic squeeze. Let's hope that sanity prevails and Trump does pull back from some of the things that he's doing, because the fundamentals are certainly deteriorating quite quickly in America. The jobs numbers are under pressure, of course, because people are being put off, laid off. So the jobs growth is going to struggle. We've got consumer confidence plunging now below 100. It's down to 98. That's the lowest level in 15 months. And the American stock market, I guess like most stock markets, but probably more than any other, functions so much on consumer confidence. 70% of the US economy is consumer spending. So when consumer confidence plunges as quickly and as significantly as it has, it just has to have an economic consequence. And that is likely to play out in many areas of the market in terms of earnings. The bond market is now factoring in 2.9 rate cuts for 2025 instead of just a couple of weeks ago, just one. And I think the concern there is that we could end up in some sort of recessionary conditions of some sort. And so whilst inflation was not necessarily defeated, in fact, there are certainly some indications that it's far from it, the Fed may be forced to stimulate more. Now, this is only the bond market forward thinking, forward anticipating, so it may not come to pass. But the key point here is there has been a fundamental shift from basically one rate cut to 3 rate cuts in a very short period of time. So what all this means is that you've got enormous uncertainty and change in very, very short periods of time. And markets absolutely hate that. So it's no wonder that stocks are being sold off, because very few people have any confidence about where to next. And of course, over the top of this, we've got the inflationary, or the very likely inflationary impact of tariffs. And the ISM manufacturing data shows that costs are rising, input costs are rising. So higher inflation in the future is not some theoretical given. The evidence of it is being seen on the ground right now. So this is creating a very tough situation for the Fed. It's hugely uncertain, and it's made even more uncertain by the fact that Trump changes his mind every 5 minutes, and the markets know it, and so have no idea of what is probable or what is coming next. So what do we do in terms of positioning? Well, from my perspective, as I said last week, we're entering a phase, however long that phase is, that will create fabulous buying opportunities. And I'm sure if you've been in the market for a while, you've looked back after these type of events and wished that you'd bought. You know, it's so obvious in hindsight. Well, it can be pretty obvious in real time as well. So you don't have to wait 6 months to look back and say, gee, I wished I'd bought there. That would have been a wonderful opportunity. Because there are things that you can do to enormously increase your odds of participating in some of those great moves. So it's a matter of doing the homework early and identifying what are the stocks, what are the characteristics of those stocks that is going to cause them to fall less in a general market correction, and then to bounce first before the general market hits bottom. And there are certainly a number of areas that you can look that improves your probability. From my perspective, staying with growth stocks is always the best place to be, but the right kind of growth stocks, because if you've got growth, it only takes a certain amount of time, and that growth will cover up perhaps formerly excessive valuations or whatever it might be. But if you've got growth stocks, then you've advanced your cause significantly. Founder-led businesses are always a really good source of stocks that are going to do better than most. And history shows that well-run, quality, founder-led businesses do better over the long term than the general market, and often by a very, very significant margin, as in hundreds of percent. So that's always a good source. And a very significant part of the portfolio within the Insiders Club is formed by just these sort of stocks. And the success of that portfolio over the last couple of years is largely down to founder-led stocks. So anyone who wants to really get into that area, then come and join us, because we're already well and truly on that track. It's been paying dividends. So that's a good source. Companies, and again, these are quite possibly also founder-led companies that can grow quickly without having to raise capital. And when you look into some of the best performing founder-led companies and you look at the number of shares on issue going back 5 or 10 years, it's insightful how many of those companies have raised very, very little additional capital. The number of shares on issue is not that different from when they first listed. So that's always a terrific sign of a company that can grow quickly and shareholders are not going to get diluted by capital raisings. Next, companies that have got seemingly limitless runways, either into new verticals, so new markets, certainly new geographies, and they're able to scale on a global basis without having to inject massive amounts of new capital. And again, some of the very best performers, and we're talking, some of them have gone on to become 10 and 20 baggers over the years, have had that ahead of them. Of course, all these companies only succeed because they're driven by very powerful long-term themes that aren't going to change. They're not going to change just because of the policies of one US administration. The reason for these companies expanding is far deeper than that. So once you've identified the type of stocks, or the style of stock, if you like, that has the capability of just continuing to grow and grow no matter what's going on around it, then it's a matter of monitoring the money flows. So get the list first, qualify the list. As I said last week, get yourself in the right ballpark and then monitor the money flows. Because when we're in markets like this, they can get quite volatile and quite irrational. So you can't hang your hat on the fact that the fundamentals are right, therefore the price should go up or the price should not fall. It just doesn't work that way. So you need to do whatever you need to do to get yourself prepared for an extended corrective phase. And I'm not saying that will happen. I think that the jury is still out on that. But you certainly should have already done the preparation for that in case it does play out that way, because to my mind, that's where the odds sit. So it's a matter then of monitoring the characteristics on the way down. And there's multiple things, I won't go into them now, but there's multiple things that you can look for that give you clues early on. Right now, the way that some of these stocks are behaving are giving us signals, giving us clues about the fact that, the price is going down, but that stock is actually being pretty well supported. So there's characteristics on the way down that give you insight. And then, of course, the emphatic reversals as the smart money moves back in. And in many cases, that will occur well before the index, months before the index bottoms out and turns up. So if you're using the index as your cue of when to get into the market, then you're leaving a great deal on the table because some of these stocks have already moved a significant way. So that is the positioning that is really important right now. It's not too late. Some stocks have gone down a fair bit. The indices, not really so much. So it's not too late to adjust your positioning, but that work in that list, that preparation needs to be done now. And as I say every week, it's easier to lose money in the stock market, and it's certainly that is the case right now. It is quite easy to lose money in the stock market right now. You've got to be really on top of your game. You've got to understand the style of stock, the kind of stock that is suitable for your psychology. You've got to have a game plan mapped out as to entries and exits, and you've got to be prepared for that and not just play it as it comes. If you're playing it as it comes and just reacting to what the market is doing, then it's pretty probable that you're going to lose money. So this is a time like no other where you've really got to have the process in place. Turning now to American stocks, the S&P dropped just over 3% and the NASDAQ a little worse than that. So it was another quite negative week. The Russell was down just over 4%. The equal weight S&P is still holding up a little better. So we certainly aren't getting some drag from the biggest tech stocks. The equal weight S&P only down 1.9, still down 2% for the week, but certainly it shows that there's some parts of the market that are holding up better than others. And as far as last week goes, 10 of the 11 sectors finished in the red, so pretty bleak week. Now, when we get to the charts in a minute, you'll see what I mean, but given the fundamental backdrop, the risk about inflation, the risk about consumer confidence, all these risks, just the risk Trump changes his mind in 5 minutes' time. It just feels like it's too early yet for a general market low. There was what could be interpreted as a reversal on Friday night that could lead to a bounce. And I think in the short term, that's probably a 50-50 proposition. We may get a follow-through bounce to the upside. We may not. But if you're stepping back and looking for a major market low, I just think it's too early for that. Then I'll explain why. But having said that, some individual stocks will and do. So again, this is where the preparation needs to be done now. The US dollar really fell apart during the week, down to 103.9. So it's down nearly 4% in a pretty short period of time. The 10-year yield edged a little bit higher, but look, it's still well off the highs that we saw around 4.8, 4.9 not that long ago. And the VIX is now living above 20, which is significant. So we're at a key inflection point at the moment. Let's go and look at some charts. All right, this is the S&P on a weekly chart. So you can see that it's still looking like, on a weekly basis, it's still a pretty decent trend. All the moving averages are still heading up. The price now is starting to spend a bit more time below the 20-week moving average. So there's no question we've got a bit of a change of character, and you can see that more obviously when we go to the daily chart. So you can see we've got a lot more emphatic red candles since this peak in the middle of February. So that's pretty obvious. And we've obviously got a pretty clear downtrend. We've taken out the last swing low. The shorter term moving averages are now rolling over and the price is significantly below them. So you can't look at that and say, we don't have a change of character. But if you look at Friday night, you can see that the market opened at this level. It then traded down, and then intraday it reversed and closed back up almost on the high of the session. So that's a pretty positive reversal. And I think it's likely the fact that it traded down and reversed in the middle of a session is meaningful. So this could be a tradable bounce. But if we look at the bigger picture, and I'll go and look at the NASDAQ to do that, I just think it's too early for that to be the most likely outcome. I think the most likely outcome is the indices go lower and we get a few bounces along the way. And if we go back to late 2021, when the NASDAQ peaked and then basically declined virtually for all of 2022, we had a definite change of character. If you look through here, predominance of green candles, so candles that are finishing closer to the highs. And then when you look at this period through here, there is a definite change where we've now got a predominance of red candles and some of them reasonably lengthy. So we're getting more emphatic selling. There is more selling in the market than there is buying or buyers. Now in 2022, there were 5 legs, and this is a weekly chart. There are 5 legs to the downside. There's the A leg, we get the bounce. The B leg, we then get an extended C leg to the downside. We then get another bounce. And then we go down to the final low, which then forms a triple bottom. 1, 2, and then 3. So from a big picture point of view, that's a pretty classic textbook decline and reversal. 5 legs to the downside, triple bottom, and then off we go. And you'll notice that as it turns, we flip over from being predominantly red candles to predominantly green candles. So it's all pretty clear. The danger, if you like, is that your mind doesn't actually absorb it because you're in a bit of turmoil because of what's happened to your portfolio coming down through here. And whilst you might see it, your mind doesn't actually acknowledge it. And so you hesitate and you don't act quickly and you're not prepared to trust what you're seeing. And that's why the vast majority of people miss out on these opportunities that can set up some wonderfully profitable trades over many years. If we look at 2022, however, Australian gold stocks, so basically all stocks are taking their cues to varying degrees from the US market, but Australian gold producers, by the time we got to the end of 2022, they'd been rising for the best part of 6 months. And whilst it varies from stock to stock, the average gain was something like 40 or 50%. So if you hadn't been alert to that opportunity, then again, you'd get to the end of the year and you'd look back and think, gee, I wish I'd taken that trade. There's an opportunity this time for that not to happen, for you to get ahead of the game instead of being behind the game. So that was 2022. Now, if you then come back to where we are now, we've had 3 weeks to the downside. They're reasonably emphatic, but it may not be a change to a cyclical bear market. This could just go sideways. I think that's less likely. I think the higher probability is that the major US indices do continue further to the downside. We've taken out this low here. This wasn't an unimportant support level that got broken. So we took that out fairly emphatically. Now, with the turnaround on Friday night, we may get a bit of a short-term bounce, just as we did over here. We got a tiny little bounce there, and then we got a bigger bounce there. So markets don't go in one direction. So if we are going into a cyclical bear market, then it's not going to go straight down. It's going to go down somewhat begrudgingly, I suspect. So I don't know whether this is a move into a cyclical bear market or not, but I'm just responding to what I'm seeing in the marketplace. I think it is the higher probability at this point in time. And again, if we just go to a daily chart and you have a look at Friday, that is quite possibly a tradable low. In other words, we'll get a bounce. And it's then the nature of that bounce. Is it a fair bit and rapid, in which case that tells you something? Do the sessions finish on their highs? So is there quite a definite buying pressure right into the close? All those things give me clues as to what comes next, because that's all we're doing as traders and investors. We're trying to interpret the balance between buyers and sellers. And if you can do that well, then you're miles ahead of just about everybody else. So the nature of this bounce, if we do get one, will be really, really important in informing us about the depth and the time frame for this correction, if that is indeed what we're in. If we go to the sectors, you can see we had a little bit of a bounce on Friday, but pretty much all of these sectors have been in decline over the last month or so, as you would expect. Rather than show the relative comparison this is ugly for Australia, so these are the sectors for Australia, but let's go and look at, first of all, the ASX 200. So the key things to take away here, we've broken the 200-day moving average quite emphatically. We've taken out this low, important low, because we had support here and here and there and there. So multiple support levels. That low got taken out very easily. We've now got the shorter term moving averages starting to roll over. So, this is now doing what I've been saying for months should have happened. And a lot of that was because of the valuation of the banks, which just looked absolutely excessive. But look, a lot of people have been saying that, so that's no big statement. So we're now getting that situation coming to fruition. And if we look at the Australian sectors, this is on a weekly chart. Materials, it didn't do too badly. They finished reasonably flat, but they'd been hammered the week before. But if we look at information technology, had a very tough week, obviously worse the week before, but there was some individual things that contributed to that, particularly WiseTech Global. Healthcare is just in the middle and pretty much the same. In fact, I think the only one of the 11 sectors in America that went up last week was healthcare, but it was only by a whisker. The other 10 sectors all fell. There's the banks on a weekly chart. So we've now broken key support and we're now into a corrective phase. It's just been screaming at us for months and months and months that valuations were just way above where the long-term historical norms should be. And you've got to ask the question with the Australian banks, why? Why, this is hardly a favourable condition with so many businesses going bust. It's hardly a buoyant economic environment. The only reason we've got positive GDP is because of immigration. So, hardly a great environment for banks, and yet they were trading way above normal historical valuations. And of course, energy has had another very bad week. So energy and banks were the two huge drags on the Australian market. Just before I go back to the slides, let's just look at the currencies. You can see the US dollar fell very sharply last week, and 3 of the last 5 weeks have been very sharp to the downside since we peaked out here at around 110 at the peak of the euphoria on the Trump trade post-election. And since then, it's been, again, quite a change in character. You look at this rise here. This was early October, so 5 or 6 weeks before the US election result. It was known, but it was extremely positive. Just look at all the green candles, and now it's extremely negative. And you've got to say that path of least resistance is to the downside. And if we look at the Australian dollar, though, given that for the week, you would have expected the Australian dollar to have done better than it did. So that's a very, very weak response to what happened with the US dollar. So pretty concerning, that one, because again, it brings into question if this support level breaks, then we're looking at sub 60 cents, and that just has to contribute to inflation. So things a bit precarious in the Australian market. So just confirming, 62.5 was where we finished. Our index was down 2.75% for the week. We've got a clear break of the 200-day moving average for the first time in 18 months. But having said all that, there are many smaller stocks that have been very resilient to the selling pressure. And I do regular videos in the Insiders Club that highlight what current portfolio stocks are doing. And one of the points that I've made over the last couple of weeks is just how resilient many of the portfolio stocks have been. Some have fallen, but the majority of those stocks have been very resilient to the selling, and they're still pretty close to all-time highs on a big picture level. It was a horror week for energy, and of course financials are probably going to have more downside as well. Turning now to precious metals, gold managed to bounce back up. So last week we had a break of 8 successive weeks of gains for gold. The possibility that was a medium-term peak, but not to be. Fortunately, it was only 1 week down, and gold bounced straight back up again to 29.11. In Aussie dollars, pretty much unchanged, 46.18. Silver did well, back up to 32.5. So as far as the underlying precious metals go, the very powerful trend that's been in play now for some time remains intact. If we look at local miners, they've trended well, but they're still lagging on a relative basis and still lagging badly, given what gold has done in the last couple of years. Australian gold producers should have done a heck of a lot better, given where the Australian dollar gold price is, because it's really the Australian dollar gold price that is driving their profitability, and it's gone up a lot more than the US dollar gold price. The Australian gold stock should have done a lot better, so they remain attractive, but the market just doesn't seem to be embracing them the same as it has in past cycles. And that is why for years and years and years, I have sought out gold stocks and other commodity stocks where you're looking for value uplift in the share price, but you're not relying on the underlying commodity to be the main driver, because then that's out of your control. We can't control the price of copper or the price of gold, but we can control the stocks that we buy, and only buy the best assets, the best proven management teams, etc., because then you've got project development, and or you've also got the possibility of mergers and acquisitions cycles kicking in as well. So if you can get other things that you have some degree of control over, because you can express your discretion on the way that they're managed and the assets that they hold, then that gives you an advantage, a definite advantage. But there is what I would call a sweet spot. Do you go for the very early stage development stocks, perhaps still in the exploration phase? Do you go for the more advanced developers, which would certainly be and has been my preference, because it lowers the risk, but it still leaves you exposed to the leverage of the project development. So for me, that's the sweet spot. Let's go and look at the gold charts. Check with silver first. So there's silver, quite a nice bounce last week, but look, it's still caught in this consolidation. So silver hasn't done as well as many people would have hoped. We're looking now at 10 months caught in this consolidation above this, what was resistance, would appear now has become support. We've still got rising peaks and rising troughs, although we do need to get a close above 35 to continue that long-term trend. But if we go to gold, so there's the US dollar gold price on a weekly chart. So you can see 8 weeks to the upside, one down, and fortunately it continued last week. And that's the gold price in Aussie dollars, not much change there. If we move now to other commodities, copper is holding solid, 468. Nickel pushed up a little bit over $7. But when you look at copper in particular, I think everybody understands that we've got a long-term situation where the copper price is going to fall into deficit, and that would almost always mean higher copper prices. But the date that happens seems to get frustratingly pushed out, and we've got multiple cross currents, and I think that is creating all sorts of uncertainty, and so the major players are not really committing in the way that they normally would. We've got a situation at the moment where I understand the US, because of the possibility of tariffs on copper, there's been a degree of higher imports, so there's some US hoarding going on, and that's creating imbalances for the rest of the world. Is that leaving other parts of the world short, and is what's driving the copper price up in the short term? Hard to know. What's going to happen with China demand? China has set a growth aspiration of 5%, but will they achieve it? Will it only be a fraction of that? No one really knows. It'll be partly determined, I guess, by the impact of tariffs. What will the US dollar do? At the moment, the short-term direction is down, but what will unfold in the medium term, again, very unpredictable because it depends on policy. And then, of course, what will be the impact of tariffs? That's the most uncertain thing of all. So you really can't feel at all confident about the background. And that's why the remarks I made on the previous slide with respect to gold and not relying on the price of the commodity, which is out of our control and very unpredictable these days, to do the work for us. That's being a victim of the market. Do all the things that you can to control as much as you can. And I think you'd be surprised that there is more that we can control than otherwise. So we're looking again in copper and other commodities look for stock price uplift because the project is progressing, the project adds value, and to a degree, it doesn't matter that much what the underlying commodity does. Now, sentiment will dictate that prices will move around short term because of the commodity price, but in terms of medium to longer term trends, they can often be different. You can get a falling commodity price, but you can get a rising stock price because the project is just moving ahead quickly. Crude oil was lower, down to 67.04. There's the spot copper chart, so you can see we've definitely got a short-term trend to the upside, but we still have to get beyond the peak of last year. So wrapping it all up, there's no question this transition is on. There is a change of character. I go through hundreds and hundreds of US charts as well as hundreds of Australian charts. And there's no question that the character of the individual stocks, the vast majority of them are pointing to the fact that the transition is on, but to what it is not clear. And it's also going to be variable. Some stocks will, in fact, many stocks will trend according to the general market, but a smaller number of stocks will do something quite different. And if you've selected well, it could be quite different and positive. The market is after what could be termed virtually assured growth, despite the uncertainties. That's the ideal. So the more you can move towards kind of stock, that may or may not be a founder-led stock, but if you can look for the characteristics of the stocks that really succeed well over the long term, then you've moved yourself into a much better environment. You've given yourself a much higher probability. Valuations become more important in this sort of environment, but they're not the only thing. The market is looking ahead and it's making projections around the future. And that is why some stocks that are already on extremely high valuations, the price doesn't fall very much and it just continues its long-term uptrend because the market sees their future growth as being highly probable. And of course, throw in some strong balance sheets, great management, they're all a part of it. So that's it for this week. Portfolio Analyst coming up. Going to be discussing in some depth the importance of style of stock. And it's really evident to me from the feedback that I get, both from within and without of the memberships, that one of the mistakes that many investors make is that they just don't have the bulk of their portfolio in the right style of stock for them. The stocks they own might be too risky, they might be too volatile, they might be too something. But that creates so much pressure on investors' psychology that they make poor decisions and they get in and out at the wrong time. And that the more that you can accumulate the bulk of your portfolio into stocks that are suitable for your psychology, and it's a very individual thing, but it's a very simple process that you can go through to identify the style of stock that's likely to be more suitable. So we're going to be doing a fair bit of work on that, as we do all the time and have been doing it. This is not a new thing for us. And of course, the development of the absolutely essential, but very simple and very effective game plan. There's just a couple of key things that you need to pay attention to. Developing a trading plan, investing plan, whatever you want to call it, is not something where you've got to sit down and spend hours doing. You can literally do it in 60 seconds. You just need to understand what are the important things and the things that you don't need to worry about. There's a couple of key things. You get them right and you've solved the majority of the riddle. So that's going to be Portfolio Analyst this week. It's going to be about making life easy for peace of mind. And the more you have peace of mind during this sort of period we're in at the moment, the better decision making you're going to make. It's just a better way to live anyway. Not always looking over your shoulder, wondering whether the US market is going to come crashing down over. There's more information on the website. There's my email address, and I'm sure we're in for another rockin' and rollin' week, and I'll be back with you next Sunday. Cheers.